Welcome to The Explainer. Okay, today we are tackling a massive, literally life-changing goal. We're going to demystify the stock market and figure out exactly how to hit that very first major six-figure financial milestone, building a $100,000 portfolio from absolute scratch. If you've ever felt like investing is just a game for the ultra-wealthy, or maybe you've just been sitting on cash because you're terrified of making a costly mistake, well, you are in the exact right place. We're going to break down the math, the mindset, and the exact strategies you need to finally get your money working for you.
I want to start off with this legendary quote from the late, great investor Charlie Munger. He said, "The first 100K is the toughest, but you got to do it." And man, that perfectly validates the beginner's struggle. Getting to this initial milestone, it's going to feel like a grueling upward push. It takes patience, it takes discipline, and yeah, it takes time. But it is absolutely crucial for your long-term wealth. Because once you finally push that boulder to the top of the hill, gravity just takes over.
So here is our roadmap for the climb today. Number 1, why the first 100K matters. 2, setting your financial foundation. 3, choosing your investment strategy. 4, maximizing your compound growth. And 5, avoiding costly beginner mistakes. All right, let's jump right into part 1, why that first 100K matters so much. The secret behind this first big hurdle basically comes down to a mathematical phenomenon called the tipping point. This is that exact magical moment when your investment returns start generating more actual cash than your own paycheck contributions. Think of it like a snowball rolling down a hill. At first, you're doing all the hard work, packing the snow, pushing it along. But eventually, that snowball gets so huge that as it rolls, it picks up more snow all on its own than you could ever possibly pack onto it by hand. Compound interest works the exact same way. It just feeds on itself like an absolute machine. To put this into perspective, let's actually look at the math behind that snowball. Let's say you're investing consistently. It might take you roughly 8 dedicated years to scrape together that first $100,000. But watch what happens next. By year 18, you hit that tipping point around $370,000, where your interest completely outpaces your contributions. And hitting $1 million, that takes about 30 years total. Just look at the incredible compression of time here. It takes 8 long years just to get to 100K, but reaching $1 million only takes about 3 times as long for literally 10 times the money. That is exactly why that first 100K is the ultimate hurdle. Moving right along to section 2, setting your financial foundation. Now, trying to invest before your foundation is rock solid, that's literally like building a house on quicksand. You really need to walk through this pre-investing checklist first. Step 1, you've got to pay off high-interest debt. Anything above 8%, especially credit cards. Paying off a 20% interest credit card gives you a guaranteed 20% return on your money, which, by the way, is way better than any stock market average. Second, if your employer offers a 401k match, take it. That is quite literally free money and an instant 100% return. Finally, build a 3 to 6 month emergency fund and stash it in a high-yield savings account. This is your financial shock absorber, so you never ever have to panic sell your investments just to fix a broken transmission. And hey, if you're sitting there thinking there's no way I can pull this off, let's look at some totally real, relatable milestones from the Lemonade investing community. We've got user Valencia, who hit her first 100K by age 22 just through clear, quantitative goal setting. Then there's Sins, who saved 100K by 24 working a completely normal civil servant job just by tracking expenses and avoiding lifestyle creep. And Gin Tonic proved you definitely don't need to be rich to start. They turned a simple, consistent $300 a month contribution into 10 grand. These are everyday people proving for sure that boring, relentless consistency really does win the game. Okay, foundation is set. Let's hit section 3, choosing your investment strategy. So where exactly do we put our cash to start building that snowball? Well, check out this ironclad beginner portfolio. You absolutely do not need to spend hours researching individual companies or analyzing complex balance sheets. Actually, scratch that. Picking individual stocks is almost always a negative-sum game for beginners. Instead, you can literally just use 2 low-cost index funds, 70% in VOO, which grabs the S&P 500, and 30% in QQQM, grabbing the NASDAQ 100. By holding just those 2 funds, you are instantly diversified across 600 of the most powerful companies in America. 0 stock picking skill required and almost nothing in fees. It's a total game changer. Now keep in mind, your strategy shouldn't just stay totally static forever. Your asset allocation really needs to evolve as you get older. When you're in that 20 to 35 age bracket, you have this massive time horizon ahead of you, meaning you can afford to lean heavily into high-growth stocks, up to 70%. But as you shift into your 50s and 60s, your priority flips from purely growing your wealth to actually preserving it. That's when you'll want to gradually dial down the stocks and bump up your lower-risk bonds and real estate to cushion yourself against any wild market volatility.
This brings us to a massive question beginners always ask. Should I dump all my money in at once or just do a little bit at a time? We're talking lump sum investing versus dollar cost averaging. Now, statistically speaking, because the market goes up more often than it goes down, throwing it all in as a lump sum usually produces slightly higher returns over time. However, dollar cost averaging, where you invest a fixed amount every single month, massively reduces anxiety and keeps you from trying to perfectly time the market. So the absolute best strategy is simply whichever one gets you off the sidelines and into the market sooner rather than later.
All right, Section 4, maximizing your compound growth.
If we want to dramatically accelerate this journey up the mountain, we need a complete paradigm shift in how we view our contributions. A lot of folks get stuck investing fixed dollars. They say, okay, I'll invest $500 a month. But fixed dollars feel restrictive, and worse, they don't grow when you get a raise at work. Instead, you've got to start investing percentages. If you commit to investing, say, 10% of your take-home pay, this magical thing happens. When your salary increases, your investments automatically scale up right along with it. You don't even have to think about it. It makes lifestyle inflation work for your portfolio instead of against it.
And if you want a brilliant, low-friction hack to turbocharge that growth with almost zero effort, try what we call the December trick. Literally just set a calendar reminder for every December to log into your brokerage account and bump up your contribution rate by exactly 1%. Going from a 10% contribution to an 11% contribution, you will barely even feel that tiny hit to your monthly budget. But compounded over decades, that single percentage point is going to add hundreds of thousands of dollars to your net worth.
Which brings us to our final stretch. Section 5, avoiding costly beginner mistakes.
We really need to talk about the silent wealth killers that routinely derail so many well-meaning beginners. First up, trying to time the market. Waiting for that perfect dip to buy in just doesn't work. Time in the market always beats timing the market, period. Second, panic selling when the market crashes. That completely locks in your losses. Third, ignoring tax-advantaged accounts like a Roth IRA and, again, leaving that free employer match money on the table. And finally, the whole illusion of safety, leaving your long-term wealth in a basic savings account, where inflation just silently eats away its purchasing power year after year. I'm telling you, boring consistency and patience are infinitely more important than trying to pick the perfect stock.
But guys, there is one mistake that is so insidious, it's honestly wild. Brace yourselves for this one. A seemingly harmless 1% fee charged by a traditional financial advisor, it can actually devour a staggering 28% of your lifetime returns. No way, right? But it's true. Think about that. You take 100% of the risk, you put up 100% of the capital, but a 1% fee siphons off over a quarter of your total wealth over time.
Let's put some actual dollars behind that percentage to show you exactly what I mean. If you are investing aggressively, let's say $5,000 a month, over your lifetime, that tiny 1% advisor fee transforms into a devastating $2.5 million loss compared to just managing it yourself with a 0.1% index fund fee. Investment costs matter so much. Minimizing fees by using low-cost index funds is one of the single most powerful things you can do to keep your money working for you instead of, buying your advisor a brand new sports car.
So we've covered the math, the foundation, the fonts, the whole shebang. The only thing left now is action. Because knowing exactly how to build a 100K portfolio means absolutely nothing if you just sit on the sidelines. So my final question to you is this. What step are you going to take today to start your snowball rolling? Are you finally going to pay off that high-interest credit card? Are you going to log in and open that Roth IRA? Or maybe buy your very first fractional share of an index fund? Please, don't wait for the perfect time. Take control of your financial destiny today and let compound interest do the rest. Because remember, every single day you wait isn't just a day lost, it is thousands of future dollars you are actively deciding not to earn. Thanks so much for joining me on this explainer, and I'll catch you next time.